Hello, Dr. Harris. My name is Gladys Gutierrez, and my co-manager is Hannah Levine, and we will be talking about our performance in the business strategy game and some of the lessons learned and trends that we learned from the business strategy game. Our initial competitive strategy was to minimize costs by spending an optimum amount of manufactured shoes and maintaining an SQ rating of 4, and that would also help customer satisfaction by optimal savings for them. Our initial ratings or ranks for the game from years 10 to years 15 weren't as good as we expected. We didn't meet the goals of the investors, but as we started to get the hang of the game, we started to do better and we started to meet the investors' expectations. Okay, and now I will talk about some of the trends that we noticed from our total annual revenues, earnings per share, return on equity, annual credit rating, the year-end stock price, the image rating, the branded and private label footwear, and the global market share. Okay, and to start off with the total revenue, the first couple of years were kind of low or not as well as we expected. And as you can see, years 10 to 11, there was a slight drop from years 10 to 11, and that is because of the advertising. It was way lower than everyone else's advertising. And in the following years, we increased our advertising expense by 13 million. And from there, we saw a huge increase in revenue. Okay, and now I will talk about some of the trends that we saw for the earnings per share. Okay, now, and as we all know, earnings per share is the portion of a company's profit allocated to each outstanding share of common stock. Earnings per share serves as an indicator of a company's profitability. And the first couple of years, from years 10 to 14, we didn't meet our expectations. Our numbers were slight low. And in year 15, we gradually managed to increase our earnings per share by a great amount, exceeding the investors' expectations. And we did this by borrowing extensively to purchase and build capacity. And this capacity expansion led to our growth from years 16 to 18. Another very important factor that helped increase our earnings per share was that in year 16, we started to pay out stock dividends, which we started out paying low and gradually started increasing that price. Okay, and now I will be talking about some of the trends for the return on equity. And the return on equity measures a corporation's profitability by revealing how much profit a company generates with the money shareholders have invested. The return on equity is useful for comparing the profitability of a company to that of other firms in that same industry. And as the chart portrays, we didn't meet our investors' expectations for the return on equity until we reached year 15, and that is due to the fact that we didn't have enough capacity for our company. But starting year 15, we gradually managed to expand those numbers. And now I will be talking about the credit ratings for our company. Okay, and so credit rating is an assessment of creditworthiness of a borrower in general terms or with respect to a particular debt or financial obligation. So it is basically what a bank or financial institution looks at if a company wants to borrow money. And as our graph indicates, we maintained a pretty good credit rating from years 10 to 20, unless year 11, and that is, I believe, because we made a mistake of selling all of our capacity, and that made it really bad. But we went up pretty good because we did borrow some amount, but we paid all of our debt in time, and that also allowed us to keep our interest rates quite low. Okay, and now I will be talking about some of the trends for our stock prices. Supply and demand in the market determines stock price. The price times the number of shares outstanding is the value of a company. Earnings are what affects investors' valuation of a company, but there are other indicators that investors use to predict stock price as well. And as I had mentioned previously, also what helped increase our stock prices were the dividends paid from year 16 that we were paying to investors that helped to increase our stock price increase. Okay, and now I will talk a little bit about the image rating for our company. And we never managed to reach that ranking of 70. We were always low, and that is because we didn't have any celebrity appeal for any of the years, and we also didn't work on any of the corporate or social responsibility. And that is due to the fact that it affected our earnings per share and return on equity values. And so we thought it wasn't worth it messing with the corporate or social responsibility, because it wouldn't increase our image rating that much higher, but it really would lower our earnings per share and our return on equity. Okay, and now we'll talk about the branded and private label footwear. And as the chart indicates, we only invested on year 10 for the private label. And that is because another team, I believe it was Team D or one of them, pretty much killed it. They did very well, and there was no way we could meet or beat that expectation. So since we couldn't compete with them, we just decided not to invest in the private label sales. So by increasing to 499 models, that really helped increase our global market share. But if our internet price was 40% higher than the wholesale price, the global market share would have been much higher. Our wholesale segment market share was at 13.3%, and the internet segment market share was at 16.4%. So we could have increased our internet segment in order to increase our global market share.
Hello, Dr. Harris. This is Hannah Levine, and up next I will be talking about our strategic vision statement. Our vision for the next 3 years is to take control of the low-cost, low-SQ rating segment of the market to increase our overall sales. We aim to produce affordable shoes that are ideal for the masses. By offering a wide variety of models, we can make ourselves stand out next to the competition. In the next 3 years, we will also work on getting our production costs down to keep offering a high number of models and to increase our operating margins. So for our 3-year strategy for the years 15, 16, and 17, our primary goals were to corner that segment of the market with low cost and low SQ rating, and stand out from our competition by offering a reasonable price as well as a high number of models to differentiate from our competitors. And we also wanted to increase our profit margins as part of our strategy, because in year 11 our operating margin was 28.3%, and it had steadily been declining up into year 14. It had been 14.5%. So one of our goals was to increase the profit margin and to stop declining. So when we made our strategy, this is the market snapshot that we had to look at, and we really wanted to offer a high number of models to get into this area, and we really wanted to have a low SQ or keep having a low SQ rating because no other teams seem to be in this area. They all seem to be bunched up at like maybe 4 or 5 stars or higher. So we really wanted to take over this corner and have many products and a low SQ rating. And in year 15, we moved to this corner like we had wanted to, and our market share increased on the internet side to 12.6% from 12%, and on the wholesale side it increased to 12.8%. So a small increase from the year 14 to 15 when we started our strategy. In the next year, year 16, we held with our strategy, and we were able to increase our market share even more, and we decided to up our models even more to about 298 on the internet side and 304 on the wholesale side. And by increasing our models, we were able to jump up to 17.4% market share on the internet side and 15.1% on the wholesale side. In year 17, we also decided to increase our models even further. We went from 298 to 345, and our market share also showed an increase. So each time that we increased our models, we increased our market share, or it increased our market share, and so that seemed to be working for us up until this point, and no other teams really are competing with us. They're kind of competing with each other at this point, like around 4 or 5 stars and maybe like 8 or 9 stars, but not too many in like the low SQ rating. So that was what was most attractive about this strategy, is because there didn't seem to be any competitors with us. However, we had to make a strategy change after year 17 because it seemed that Team I thought that we had a really good strategy as well, and they saw that we didn't have any competition, and it seems like they took our exact strategy almost, and so we didn't really like that, and so we increased our models, we increased our models to the maximum amount that we could, and we also increased our SQ rating at this point because I wanted to get us away from Team I, and I thought that maybe moving to the right and up on this chart would be the best option. But as it turns out, they thought that would be a good idea too. So we both kind of, Team H and Team I, we both moved into the same kind of direction again. But our market share still held at about 12.6%. So it went down from year 17. And for the next year, our strategy was no strategy, since everybody seemed to be moving all at once into this direction. I figured maybe they would all try to move again, so it kind of worked again. B and D moved up and away, and Team I kind of moved down away from us again, and we regained some of our lost market share that we had lost previously to Team I. And for our private label portion, of the business strategy game, we didn't really focus on private label because Team D really did take most of the market by year 12, and their costs were just too low to compete with. I believe they were selling shoes for $24, and we couldn't even produce them for that cheap at that point, so we really couldn't compete. So we decided to divert our attention to the non-private label shoes. For our lessons learned, we did not set our internet price 40% above our wholesale price, and for that reason our two markets were competing basically with each other, and had we set our prices farther apart, we probably would have had more market share. And like I mentioned on the last slide, we didn't do well in private label because Team D took control early on. So if I could do it again, I think I would focus on private label definitely a lot earlier before someone could just dominate it like Team D did. Another lesson that we learned was about our image rating, and it was consistently low due to the lack of celebrity endorsements. However, we did not see that reflected in our revenue. We also learned that expanding our capacity helped to get our costs down, and that was one of the main things that helped us increase our margins down from 14% in year 14 up to 33% in year 19. So that was our presentation, and thank you.